Welcome back, folks. It's a bright and sunny morning on Dalal Street, but it looks like it's going to start off well in the red. At least that's what the SGX Nifty is indicating. But so many stocks to talk about. Good numbers coming through from HDFC Bank, and we have Abhishek standing right by to tell us how the numbers look this time. Abhishek, good morning.
Good morning, Sonia. So it's a stellar quarter from HDFC Bank, given the fact that, net interest income growth on a YoY basis is perhaps the best in last 13 quarters. And on a sequential basis, it's the best in last 16 quarters. So to start with, NI growth was at 18.9% YoY and about 8.9% sequentially. So the declining trend of net interest margin has been arrested. And for the first time in last 8 quarters, we are seeing a margin uptick for HDFC Bank coming in at 4.1% when compared to 4% in the previous quarter. The core operating profit growth, which had been lagging big time, has grown at 16.6% YoY and about 5.8% sequentially. The asset quality has improved. Gross NPA ratio is at 7-quarter low at about 1.23%. The annualized credit cost is down about 10 basis points sequentially. On the flip side, the CASA growth rate on a YoY basis has been below the overall deposit growth for the first time in last 7 quarters. So merger process, that is what management highlighted in the con call, will be 1 quarter ahead of their earlier target. So their earlier target was Q2 FY24. Now it will be done by Q1 FY24. So PNL, both in terms of NI and PAT, is ahead of our poll. Brokerages remain bullish. Target price ranging from as low as 1690 per share to as high as 1950 per share. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Mangalam joins in to tell us about Avenue Supermart. Mangalam, numbers a little disappointing?
Well, the margins were a miss, and that's the headline for Avenue Supermarts this time around. The EBITDA was below street expectations, even as the net profit was higher, but that was largely on account of a 140 crore tax write-back. The revenues, largely in line, mildly better than expected on a consolidated basis, because the company had already given us the standalone revenue for the company in the second quarter update. So just to run you through the numbers, 10,638 crores in terms of a consolidated revenue, mildly above street expectations of just under 10,600 odd crores. EBITDA coming in just shy of 900 crores, so the street was working with a number well upwards of 950 crores, and that is why the margins missed. The numbers came in at 8.4% versus street expectations of 9.1%, and the net profit was higher on account of a tax expense cut of almost 60% year on year. But importantly, the management commentary has not, given much confidence as well, because they're saying that the inflationary stress is more acute at lower price points, and this is something a lot of FMCG companies have been saying to us as well. Footfalls continue to be lower than pre-pandemic levels, and discretionary items in the non-FMCG segment are still not back to pre-COVID levels. Even though they're recovering, they're still not back to pre-COVID levels, and that is something that may cause a bit of a worry. The stock is already 26% off its highs, trading at around 84 times, but DMart has always traded at premium valuations.